Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing wonderful. Hey, something I heard about in the syndication world that I really don't understand, it's not my world, that I thought you could help us define, and then talk about how this might work in a changing environment. You ready?
Yeah, absolutely. So what I wanted to talk about was called preferred equity, right?
Mhm.
Now, preferred equity has always been around, and what it is, it's essentially a part of the capital stack that is a little bit like debt and a little bit like equity. So the way preferred
Okay.
equity works is you guarantee a return to an equity investor, right? So this
Okay.
means they take the risk of loss. They can't foreclose on your property because it's not debt. They don't have a lien, but you
Okay.
are guaranteeing them a return, right?
Mhm.
And the return is usually less than what you project that you're paying to your common equity investors. So let's just say,
Okay.
for example, you're projecting in your deal, um, you're going to get a 20% return for your
Mhm.
equity investors. And obviously, a lot of that's going to come on the back end when you sell.
Mhm.
For your preferred equity, maybe you're saying, hey, we're going to pay you, we're going to guarantee you 12%, but that's it. You don't get any upside. You just get your 12%. And maybe that's 7% cash on cash up front and 5% on the back end when we take you out to catch you up. So it's an overall 12. And the
Mhm.
reason people are willing to do that is A, for the guarantee, but and B, because you're higher up in the capital stack. So you sit, you know, in between the debt and the equity, you're in between there. So what that means is that it's a safer investment than
Mhm.
common equity, right? Because say in the event of a liquidation, the debt gets paid first,
Okay.
then the pref gets paid, and then the common equity gets paid. So if you look at
Mm.
it in reverse, what gets wiped out first is the common equity, and then you have to burn through all the common equity before you touch the preferred equity, right? So
Got it. Okay.
um, so you probably will have like a typical that kind of capital stack would be like 70% loan, right? And
Okay.
then maybe 5 or maybe 10% preferred equity, because it really doesn't work if it gets too big. And
Right.
then you have 20 to 25% common equity. So the preferred equity players are thinking, okay, this deal has got to lose 25% of its value before it hurts me, right? So
Got it.
they're
Okay.
basically using the common equity as a buffer to
Mhm.
protect them,
Sure. Makes
but
sense.
they're giving up upside, right? So they're saying, look,
Mhm.
we're more secure, this is safer, uh, but we're going to take less of a return because of that, and we're going to forego any upside. So all the upside is yours. And so the reason people like to use preferred equity is because it's in a way like putting more debt on the property. You get more leverage, which means that your returns for your common equity are higher because
Sure.
it's just like having more debt, but it's not like debt. It's safer for you than debt because they can't foreclose on the property and wipe out the common equity, right? The
Mm.
way that
Mhm.
additional debt could do, right? So,
Okay.
and also a lot of deals are structured. Most loans these days will say you can't put a second mortgage on the property either, right?
Right.
So,
Of course.
so this
Mhm.
is this is a way that you can, back in the day when I first started, you could get your senior debt on a property, 75%. And then you could go and get another piece of like what's called mezzanine debt for like another 8 to 10%. And you could
Wow.
leverage up the deal to like 85, 90%. And
Wow.
and then so your equity would get really great returns because they were getting all the upside, right? And so
Right.
and 93% didn't participate in the upside or whatever it was, 85% didn't participate in the upside. So it was all on all the equity, you know.
Mhm.
But the bank said after the financial crisis, the banks were like, no way,
Nope, not doing that again.
can't do that anymore.
Yeah.
Everyone was over leveraged. So, so preferred equity, which had always been around, kind of stepped in to fill the gap when pricing got really out of sort of crazy. It didn't need any preferred equity back when you were buying at 7 and 8 caps, but when you got to buying at like 4 and 5 caps, the only way that you could get your common equity to get the kinds of returns that they wanted was to put in some pref equity
Mhm.
in between, and then and
Okay.
sort of so acting like additional leverage. Now there are a couple of different sort of flavors of preferred equity, right? So one is I just made this up. I don't know if other people call it this. I just call it sort of preferred equity light, which is kind of when you go to your investors and you say, hey, look, I'm going to offer you two different options here. I'm going to offer you a higher preferred return with no upside for people who want cash flow. And I'm going to offer you regular equity that's going to have less cash flow up front, but you participate on the backside. And
Okay.
they call that preferred equity, right? So maybe that slice of the pie would get a 10% preferred return and nothing else, right? And they would take it because the common equity, maybe in the first 3 or 4 years of the deal, was only getting 2 or 3%, right? So they're like, hey, I'm a cash flow investor. I don't really care so much about getting a big chunk of money 5 years from now. I need to live off this investment now. So they were willing to forego the upside to get the cash flow now. And when you have that small a piece of preferred equity, you can pay them that 10% and still pay everybody what everybody needs to get paid. It still works, right? So there's that sort of preferred equity light. However, a lot of people went, instead of doing preferred equity light, or even sometimes in addition to do it, doing true preferred equity, which is when you go to like a specific preferred equity investor, which is typically private equity firm, and you would pay them something like, a 7 or 8 cash flow pref ongoing, and then they get points on the back end that maybe take their total return up to 13, 14%, right? And but that allowed you sort of currently to pay more cash flow to your equity and et cetera. Now, the problem with those investors, which I shouldn't say the problem, the first kind of preferred equity, the preferred equity light, those are just like your regular retail investors. They're just taking a different deal, right? They're just taking
what's
a different
better
deal.
for them. Yeah.
What's better for them, right? So you're just offering 2 classes of shares, and they're just picking the one that they like better, right? And some people would do some of both. They invest a little bit of pref, a little bit of common, right? So just because they had their own financial objectives to meet. The institutional preferred equity, however, they're typically coming in with pretty big check, in the millions of dollars, and they're very sophisticated and they want to be secure, right? So they can't foreclose on the property because it's not debt. And if they did have that foreclosure right, the banks would kick them out. You'd be in default of your loan covenants because that would really be debt. So they don't have the right to foreclose on the deal. What they do have the right, however, to do is kick out the operator if things don't go the way they want them to go. So where are we now?
Right.
It takes us to where we are now. I think we're going to see a number of deals happen, where people, for instance, got variable rate bridge debt to do their deals, right? And they didn't buy a rate cap, or they bought a rate cap that was too high, right? And now their debt service has gotten to the point where they are not, they've stopped paying their common equity, right? Because they can't pay them anything. And they say, well, no big deal. It just accrues to the end. They're not making their payments to the preferred equity, or they're only making partial payments. And depending on the deal documents that they have in place, maybe if they've got a generous pref equity, sometimes they even call them pref equity lenders, but even though they're not lenders, if they've got generous pref equity investor, maybe they're able to accrue to the back. But if that pref equity investor is more, kind of hardline type, they may be finding themselves, booted out. And now,
so let me play this out for somebody who may be in a deal where the primary operator gets kicked out by this preferred equity provider. They're actually not wiping out the common investor. They're just taking over the operator, saying, hey, Mary, go away, Bob, or we're stepping in, something like that.
And look, I mean, maybe for you as a common equity investor, maybe you might
be a good thing.
You might be better off. Yeah, you might get a stronger operator in there than the one that you had, right?
Probably,
potentially. But at the same, and when that pref equity investor steps into the shoes of the operator, they're going to owe you a fiduciary duty,
Absolutely.
right? So, but nevertheless, like, that isn't the person that you.
That's not who you put your money behind.
That's not who you went into business with.
Right.
And that preferred equity investor, whatever their fiduciary duty is to you, they are going to operate the deal in their own best interests,
Of course.
and
Yeah.
and their primary interest is getting their money back, right? So
Yep.
they, this is going to be interesting how this plays out, but I'm quite
So in
certain.
theory, right, just playing this out, right, you get into a $10 million deal. There's 20 million in common, 5 million in preferred equity. So you've got a loan of 7.5, if I'm doing my math right, or whatever. And we kick out the operator because this, that, the other. In theory, the preferred equity could come in and fire sell that thing for 8.2, get all their money back, and then the limited partners or the common equity is impaired.
Yeah, I think in theory that could happen. Now you might wind up with like litigation where the common equity is like, hey, you breached your fiduciary duty to us by selling it too low. You should have gotten a better price for it. But now it's like a bunch of like,
Yeah.
like doctors and lawyers and tech guys like fighting against some very sophisticated private equity firm, right? Good luck with that. And
Yeah, that sounds expensive in the best case. Yeah.
yeah. And I mean, they know how to run the clock out on, they're going to run up your legal costs, and it's just not going to be worth your while, right? You're just going to be throwing good money after bad at that point. So,
I think so. Yeah.
so yeah, I think that this is like a scenario that a lot of people haven't really thought about.
It's coming.
And,
Yeah.
and I think on some of these, it could be coming on some deals, right? Where they were overly aggressive in how they were structured. And let's, be honest too. I'm sure that there are some of these, preferred equity providers who are actually looking
Oh, for sure.
for this scenario, right? Where this is the reason they were in the deal, because they were thinking, okay, what's the worst case scenario here? Well, we take over and we get our money back, and we take over the deal, and when this operator is out, and we're going to take over their position. So, they were a little bit predatory. I know that, there are a couple of groups that
there's no question. I mean, this is something I saw in 2012, 13, 14 in what's called hard money in residential game. I know there were operators, and I've talked to them that were like, hey, we're lending to these people because we like the asset.
Yeah.
And if this person doesn't pay us, we get it at 70 cents on the dollar. They're like, numbers say somebody's going to miss and we're going to get an asset at a discount. This is the same thing with preferred equity. They did it on basically what I saw in residential is the best asset is where the people wanted to play. Right. The best asset, weakest operator. It's kind of a magic combination.
Yeah. It's not to say that, frankly, every preferred equity investor is going through the same mental process of, well, what's the worst case scenario?
You would think so.
Right?
Yeah.
Right.
Yeah.
And the same thing with the hard money lenders. They're all going through this, because they want to be secured in their, because
they want their money back.
They want their money back, right?
Plus the return, yes.
Right. So this is not in any way to like say that all of these players are predatory, not by any stretch. But and they're all thinking about the downside, and they're all thinking about, well, I may have to take, if I have to take this deal over, is it a deal I want to take over? But there are definitely some vulture players out there who are part of their business model is looking for deals that they want to take over, and
exactly,
and it's not, they're not at all upset if that's what happens, right? So, and they know that they're protected in the sense that they're higher up in the capital stack, so the common equity is going to get wiped out before they are, if there's a fire sale situation, right?
Awesome.
So,
Jonathan, thank you for the education. This is something I'd seen, not really understood. You've made it crystal clear and also painted a vision of what may happen in the future. Where can somebody follow you? Because you put out a lot of great stuff.
Yeah, so if you want to join my email list, we're starting to put out a newsletter every week. We've got my links to my podcast, got other stuff that you can grab in there. Go to apartmentinvestorsclub.com and you'll be able to sign up. You get a free download about multifamily investing if you do that. You can also go to my Facebook group, which is Multifamily Investment Community, or you can go to Two Bridges Asset Management. Just Google it. It's easier than me explaining the URL, and get on my investor list. And also just want to let you know about our conference coming up in April, 26th to 28th. of April in Las Vegas. You'll be getting information about that if you sign up on my list. So I encourage you to sign up on my list.
Awesome. Thank you so much.